Well, welcome to the Pulse. I'm Francine Lacqua here in London, and you've been listening to the ECB President Christine Lagarde giving her one of the main keynote addresses of the year from the Goethe University in Frankfurt for the ECB and its watchers. Now, the European Central Bank, she said, cannot commit to further reductions in borrowing costs after a likely move in June. Now, this is a big speech. She basically said that when it comes to the data that is relevant for our policy, she says we will know more by April. That's wage negotiation month, and a lot more by June. Beyond that, she says there's not much that could be said. If you look at the initial reaction to the markets, I think we have euro, dollar, but we could also look at the Germany front-end bonds, shrugging off some of the remarks that Madame Lagarde had said, because some of them were actually reiterations of remarks she made previously, including at the last ECB policy review. Now, to talk about all of this, we're joined by Anneka Treon, Chief Economist at Van Lanschot Kempen. Also with me, Bloomberg's Noor Al-Ali. So thank you both for joining us. Noor, we were listening to this together. I mean, she basically tried to give a little bit of an idea to the markets on her thinking once again. I think the 2-year German yield fully pricing in for an ECB rate cut in the summer, and then many question marks going forward.
Yeah, absolutely. What was interesting to me is that Madame Lagarde seemed a lot more confident when it comes to the inflation story that we've had in the last couple of years out of the euro area versus, just her last speech last year at this same conference. So I think there's a lot of optimism that I think is baked into this. As she was looking, I was looking at swaps that are tied to meeting dates, and those are the kind of swaps that look at or are betting on when the ECB will cut rates. They're pretty steady. We're looking at 20 basis points by June, so still not fully pricing that. But, by July, we're looking at 36, so really sealing that view. But so the market is still expecting or is putting in more weight to an ECB June rate cut compared to the Fed and the BOE, even after the softer inflation print that we had out of the UK. So it's all pointing to, signs that, inflation is headed in that right direction. It's just taking some time, and that wage data that you mentioned is really key for ECB policymakers, as they've repeatedly said.
So, Anneka, what do you make of the speech? Again, it seems that the timing of the first actually reduction is increasingly clear, but then from June onwards, many more question marks.
Yeah, and I think what she's doing very well, and other policymakers are doing this as well. I think central banks have learnt to really hold the hands of markets and market participants in guiding them, managing their expectations. And I think the two things that she managed again this morning was, number one, the visibility is very unclear. So even after the first cut, don't expect that by definition the next one is coming. It could even be a pause or even a longer pause. And number two, in terms of the timeline, like you said, but it's I think also, as mentioned just now, it's for Europe especially, it's all about wage inflation. And that's the biggest dilemma that all European economists have. How is it possible that despite such a sluggish growth economy, the labor market is so tight, wage inflation is so tight, and it's all about demographics, and that's Europe's biggest problem, which makes this complicated.
Yeah, and Anneka, I know that, Christine Lagarde, again, reiterating that they're basically data dependent. So she's looking at wage growth, she's looking at productivity, she's looking at corporate profit margins to determine when rates can be lowered. But it's difficult for the markets given the repricing also of the Fed. So if you're a trader right now and you're trading German bonds, do you look at the Fed to give us an indication of what Christine Lagarde does? I
think so. And, one easy comment is, well, Europe always follows the US, but obviously that's a bit too straightforward. But it again boils down to the wage inflation story. The wage inflation issue that Europe has is much more complicated than in the US. The US, they've managed to beat the inflation fight, so to speak, right, with inverted commas. The economy is strong. They're able to pull through and they're able to proceed. Europe is more complicated, so it's only natural and logical that the ECB would want to wait a little bit longer, also see how markets are reacting, see how the path in the US is progressing. So that's something which I think would be a reasonable thing to expect. First US, then Europe.
It was also interesting, Noor, to hear her actually talk about the transmission mechanism, right? Assuming that transmission remains strong. How's that worked? We've seen actually quite a big laggard in terms of timing of rates going up, but actually how that slows down inflation.
Yeah, absolutely. And when you say that the ECB is data dependent, as they've been saying, it means that that really exposes the market to a dovish surprise, because by virtue of the monetary transmission tool, you are expecting inflation to come down, to trickle down. Even that sticky inflation, services inflation print, that will eventually respond to those tools that, we only have those tools, right? I mean, monetary policy has its limitations. We can sit here and compare economics and, textbook theories on Taylor rule and what have you. But ultimately, what you've got here is an inflation print that is moderating, slowing, perhaps not as slow as we'd like it to be. The ECB's projections, even Lagarde has pointed to the fact that, they haven't, they've missed the ball quite a bit on that. And it has been tit for tat for quite some time. Wages and services remain key for the ECB going forward. But ultimately, as we see that inflation moderate, as we see the economy now potentially start responding to all that tightening, that quite aggressive tightening that we've seen, eventually the ECB will potentially react a lot more aggressively in a dovish manner than markets would be pricing it to. And that's where, that's where the ball game would hit. So while they say, we don't know anything beyond June, wages data in April, June, and into the summer can potentially really shift that tone quite aggressively, which is a concern for markets.
But I guess, is there too much of an optimistic bias in the markets? And we heard that, I think, yesterday from, the Vice President, Mr. de Guindos, saying, look, the market's view is very optimistic. And I think he also said, they're optimistic about a soft landing, that inflation will continue to fall. But he had a word of caution saying we could actually see a very different situation that leads to an abrupt adjustment.
Yeah.
So is there a concern that, inflation comes down and then actually shoots back up in the summer months?
Well, look, I mean, there's a lot less reliance, I think, or the measures that the ECB is looking at is trying not to account for all that commodity spike. And we have seen, if you look at the Bloomberg Commodities Index, the price index actually has come up, just recently in the past few sessions as well. So ultimately, there is this irrational exuberance that's taken markets by surprise, right? It's that AI-driven rally that's been feeding everything. But you have seen that take a breather now in the last sessions. Cryptos stepped back. Even the tech stocks have kind of come down. And you've seen that rotation in stocks. So you've seen more bond proxies, utilities, real estate rise into that, the expectations that rates will eventually be cut down this year, and we're sort of front-loading that. So, yes, there's definitely going to be a lot of question about the current rally that we've seen, but right now there's very little that's stopping that. And what the Fed does today is really key for the next few months and how that market behavior is going to be.
Anneka, what's your take on, first of all, the dot plot. Everyone's now watching the dot plot. So the Fed decides we're not expecting any policy change, but we're hoping to kind of read the tea leaves to what they do next. If you look at the Fed and the ECB, who's better at communicating what they're going to do to the markets? And is that a plus, or could it actually backfire?
Yeah, well, the dot plot's a really funny thing. So if you think about it practically, you've got 19 policy members at the Fed. They're all putting out their opinion. And their opinions are really fragmented. So if you see how many policymakers are putting out which dot, so essentially if two policymakers change their mind, the whole dot plot looks different. Then the market thinks, oh gosh, what are the tea leaves saying? And what I think is quite encouraging, because the market became far too obsessed with, did Powell sneeze harder today? Did Lagarde cough, harder? The market is now, I think, taking a step back and saying, okay, we do believe that the inflation path is looking more encouraging than a year ago. Rates are very likely to come down this year. By what speed, it is what it is. And you see that actually marginal changes in expectations in terms of when rates are coming down, that's not moving markets that much anymore. That's not causing equity markets to go all over the place, which is great news. It means that the markets are easier to navigate. And that's helped by the fact that companies and earnings and cash flows are strong. They're solid. So that's really helpful.
Anneka, as always, thank you so much for joining us. Anneka Treon there, the chief economist at Van Lanschot Kempen, as well, Bloomberg's Noor Al-Ali. Now, we need to also look at corporates, or certainly the Gucci warning is not to be missed. $7.6 billion have been wiped out from the market value of Kering after the company warned that sales at its key brand Gucci will plunge about 20% in the first quarter due to a steeper than expected decline in the Asia-Pacific region. Now, the French company has struggled to keep up with rivals like LVMH and Hermes as luxury sales have come off the boil over the past year, especially in China. You can see Kering down 14.3%. We also talk chips next, a boost for Intel as it wins almost $20 billion of incentives for U.S. chip plants. This is Bloomberg. ECB President Christine Lagarde says the European Central Bank cannot commit to cuts beyond a likely first move in June. Intel wins almost $20 billion in grants and loans to help fund an expansion of its semiconductor factories. Plus, Kering shares tumble after it warns that Gucci sales will plunge in the first quarter on weakness in Asia. Other luxury stocks also sell off. Well, good morning, everyone, and welcome to the Pulse. I'm Francine Lacqua here in London. So Intel's been awarded almost $20 billion under the Chips and Science Act to expand its semiconductor factories in the U.S. It marks the largest award from a program designed to reinvigorate the domestic chip industry to cut Washington's reliance on technology made in Asia. Well, Bloomberg's Tom McKenzie is here. Tom, we're bringing out the big guns. This is a treat to have you talk about the chips. I mean, this is basically not really antagonizing China, but it's trying to just make the domestic chip sector a lot more viable.
Yeah, and it's about ensuring that the US is less vulnerable, less exposed, and is less reliant on those major chip providers in Asia, TSMC, for example, in Taiwan, but also Samsung in South Korea. So it's about building out that domestic industry. The Chips Act of 2022, really consequential, so setting aside grants and loans worth of $100 billion US dollars, and now Intel taking the biggest slice so far in terms of those grants and loans. So about $8.5 billion US dollars. $8.5 billion in grants and about $11 billion in loans. And Intel saying that this is really going to help. They're investing $100 billion US dollars in the US market. They're building out factories and foundries in places like Ohio and Arizona. And so these grants and these loans from the Commerce Department will help in that investment push. Again, as Pat Gelsinger, the head of Intel, tries to build out this capacity in the US.
I mean, I guess the biggest fear is, that then we're going to have too much. I mean, first of all, are they going to build the good semiconductors, right? The good chips, the good stuff?
Yeah.
And is there a worry that in 3-4 years, because of this overinvestment, that there's just too much of the stuff?
Well, you make really good points on both of those issues. One, yes, they're focused on the most cutting-edge semiconductors, so not the older legacy chips. They're really focused on the kind of chips, so 7 nanometers and below, 5 nanometers, 2 nanometers. In fact, Intel have taken delivery of ASML, the Dutch maker of these high-tech lithography machines. They've taken ownership of the most cutting-edge lithography machine from ASML, the first tech company, the first chip company to take in one of these machines. So, yes, that's their focus on the really high-spec stuff. The other challenges are around ensuring that they have the talent, the workers, to be able to work in these foundries and factories. That's proven a challenge. Another frustration for a lot of these chip companies in the US is being able to get access to this funding more quickly, because the CHIPS Act has also been held up by some oversight into some of the environmental impacts. So there's a number of challenges. You're absolutely right. A lot of money flowing into this sector. Will there be overlaps? That is potentially another challenge down the line. Interestingly, Intel's key competitors, the likes of TSMC and Samsung, they are lined up to get funding as well to build out their factories and foundries in the US.
And then we also had the story about Huawei. So it's China actually possibly going after factories or links with Huawei. How antagonistic is that going to be?
Well, this is absolutely another piece of this puzzle. It's not a huge surprise that the US is considering further restrictions. What they're looking at when it comes to Huawei are some of these subsidiary companies or alleged subsidiary companies. So the allegations are Huawei has gone and funded and set up other companies under different names that don't face the existing restrictions. Huawei is already on the entity list, the blacklist. Now these other firms could be put on that list to make it more difficult for Huawei to achieve and get hold of US technology, but also technology from the Netherlands, Japan and South Korea and Germany through these other routes, essentially. So the US trying to close the loopholes that they say Huawei have been able to build out. They haven't come to a firm decision yet. We don't know a time frame, but we know it's been actively considered.
Tom, thank you so much. A terrific briefing there from our Tom McKenzie. Now to some of the other tech stories in the headlines today. And Supermicro is understood to have cut its share sale price target to $875 each, with pricing set to be confirmed just before the shares begin trading later today. Now, the company had been offering to sell 2 million shares at between $900 and just over $1,000 each. The computer server maker has gained nearly 1,000% in the last year on the back of enthusiasm for AI. And Samsung shares had their biggest gain in more than 6 months after an endorsement by NVIDIA. Well, the chief executive, Jensen Huang, was reported as saying he's planning to use Samsung as a supplier of high-bandwidth memory chips. Now, NVIDIA unveiled its next generation of AI hardware called Blackwell at its conference in California this week. And Michael Dell unloading shares in his namesake computer company for the first time in almost 3 years, as Dell Technologies stock soars on artificial intelligence optimism. Now, Dell's chief executive has been selling on a near daily basis over the past 2 weeks and has now disposed of shares worth about $465 million. He still owns about half of the Texas-based company. Now, of course, it's Fed decision day, with the U.S. central bank poised to hold rates and likely avoid signaling any imminent reduction. That's as the FOMC focuses on stubborn inflation and a slowly rising jobless rate. Now, for more, let's get straight to Ven Ram from Bloomberg MLive. Ven, always good to speak to you. So which scenarios are trading looking to, and what is to be expected from the dot plot relative to the economy?
Morning, Francine. I think that, since the Fed last met, we have had major inputs into the financial system, obviously. One of them is, if you look at the financial conditions, what's happened to financial conditions? They have loosened, and loosened considerably, so much so that they are the loosest since 2021, i.e. before the Fed started raising rates in the cycle. So even if we haven't got de jure rate cuts, we have got de facto rate cuts that the markets have priced in. That is despite what has happened to treasuries in the past week. Now, if you look at inflation since the last dot plot, headline inflation is still bobbing around 3%. Core inflation is nudging almost 4%. And if you look at the labor market, employers continue to expand their payrolls at a pretty robust pace, as we heard in February. And if you look at wage inflation, that is still running above 4%. That is hardly consistent with an inflation target of 2%. So net-net, since the previous dot plot, every input into the economy is saying that they should probably take back one of the 3 rate cuts they had penciled in, Francine.
But so what does this imply then for treasuries and other asset classes?
Well, I think, given the surge in 2-year yields that we saw in the past week, they rose 25 basis points, as you know, and that's a pretty humongous shift. Given that the front end is more or less come around to the idea that we'll get only 2 rate cuts this year. And so even if the Fed's dot plot acknowledges that today, I think that the reaction may be a bit mild. So there's not too much more of a sell-off to come on the front end. On the other hand, if the Fed sticks to 3 rate cuts, I think we'll see a bigger reaction and treasuries will rally and the dollar will be sold.
Yeah, and dollar is actually one of the big stories also, right? I think it rallied some 2% since the start of the year, whereas going into, certainly at the end of last year, this was, because of all the Fed cuts, people were expecting it to go the other way.
Yeah, absolutely. I mean, this is not the way the markets were expecting, whether it's on rates, it's on dollars, or on inflation. That's probably because, markets were too hasty in writing off inflation, and that hasn't happened at all, even in the Eurozone, even in the US, and to an even lesser extent in the UK. So far, the markets have got it completely wrong, or at least misread the tea leaves on the economy so far this year. We'll see what happens in the second half.
Ven, thank you so much. Ven ran there with the very latest, of course, on Treasuries, dollar, and the Fed. Now, some $7.6 billion has been wiped from the market value of Kering after the company warned that sales as its key brand Gucci will plunge about 20% in the first quarter due to a steeper than expected decline in the Asia-Pacific region. Now, the French company has struggled to keep up with rivals like LVMH and Hermès, as luxury sales have come off the boil over the past year, especially in China. Now, if you look at luxury leading really a lot of the European stocks lower, again, because of this 20% reduction, there was a rebound after post-COVID. So if you look at China's lackluster post-COVID rebound, it's weighed on luxury, often considered Europe's version of high-growth tech, although the tech sector has rebounded after a dip in the second half of 2023. Now, European stock investors certainly had become more upbeat on economic growth and the earnings backdrop. Like cyclical sectors, for example, such as luxury and autos, are still affected by China's sluggish rebound. That sets up one of the key European growth sector for a disappointing first quarter reporting season, unless you have magnificent product that keeps on selling. I'm thinking of Hermes and LVMH that, for the moment, have defied expectations. Now, coming up, we also speak with the chief executive of Honeywell, Vimal Kapur, on how the company is preparing for the future of automation, aviation, and green energy. That's next, and this is Bloomberg. Well, the conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacqua here in London. So many household name companies are breaking up to try and appeal to investors who want more streamlined businesses. Honeywell, which makes aircraft components, air conditioners, and automation equipment, wants the opposite. In December, the company agreed to buy the security business of Carrier Global for an enterprise value of around $5 billion. Now, it's the first major acquisition under Vimal Kapur, who took over as the company's chief executive last June. Well, I asked him whether there's space for a conglomerate that's fairly valued.
We as Honeywell are seen historically as a conglomerate, but we've done a lot of work to change two things. First is a very sharp and focused portfolio, essentially focuses on three things: future of aviation, automation, and energy transition. And second thing we focus is how we build an operating system that we run it as a company and not as a conglomerate. So we are not holder of assets and people are doing their stuff. We run Honeywell tightly as one operation across these three megatrends.
And so basically the megatrends are automation, aviation,
and energy
transition.
Absolutely.
So what does that mean for where you want to grow? I know you've also had a big acquisition back in December.
It basically means each of these megatrends are strength in themselves. So these are here forever. The aviation, we all love to travel, and the travel is going to get more electrified. We probably all going to have urban air mobility in our lifetime sometime. So there's a lot of growth there. Automation is an integral part of our life, specifically industrial automation, automation in buildings to drive sustainability. And there, the biggest growth vector for us is AI. And we can talk about that. And energy transition, hopefully I don't have to explain. The planet needs more new molecules. We're essentially focus on green molecules, less on green electrons. And each of these growth vectors are here for several years, which makes Honeywell a compelling proposition for our customers and for our shareholders.
But so if you look at aviation, and again, a lot of, I guess, shareholders say, look, you can unlock value, but at the same time, you're seeing a trend, for example, Boeing possibly looking to reacquire Spirit, of some of the supply chains coming back in-house.
Yeah.
What does that mean for how much growth you're expecting in that industry?
Yeah, for us, our business model is very different. You know, we don't have one concentrated product lines in our business in aerospace. We are nose to tail company, and we have multiple systems from cockpit controls to engines, APUs, environmental control, satellite comms in a plane. And we typically go to an OEM like Boeing, Airbus, Bombardier, Embraer, and position our entire product line because we specialize in systems in a plane. So we get a lot of content, and in every plane you fly, we have a significant Honeywell content. So your question, our equipment is so critical, and because it's a system approach, we are not really one product which is backward integrable by anybody.
But how does aviation actually change from here? How much of it will be green? Right.
Electrification is the name of the game in future. I think in our lifespan, how much of will we fly in a plane with hydrogen cells, hydrogen fuel cells? I can't.
This is what, 10 years away, 15 years away?
I think technology is being developed, but what's available right here and now is use of sustainable aviation fuel. That's a technology which we provide through our energy transition part of our business, and our aerospace business tests that in our engines and our APUs, and that's something which is available today. You can blend all the way up to 50% of sustainable aviation fuel in the jet fuel, and that to me is available today. Where it will go forward is more electrification of different parts of the aeroplane. Think about cooling in the plane, think about propulsion in the plane, And that really positions the urban air mobility as the first platform which is be totally electrified. And that's what we're really working on in the future of aviation.
How would you describe U.S. manufacturing right now? Again, there have been problems with supply chains, which also mean that there's been a repatriation of supply chains. I don't know whether that's the end of multilateralism, but certainly it's given a massive boost to a lot of demand coming from the U.S.
Yeah, so U.S. supply chain, clearly there's more focus to have more indigenous supply chain in the U.S. for the last several years. Specifically in aerospace, there's a lot of rebuild of capacity. A lot of capacity was shed off in terms of during the COVID, and a lot of people went off work. And rebuilding the capacity with increased demand is an immediate challenge and opportunity for in aerospace, which we are working on. Yeah. But we also see in the U.S. expansion of capacity in semiconductor fabs, in EV vehicle batteries, and others, industries of some nature. It will take a while for that capacity to set up. It's not going to happen overnight. But clearly we see the trend, and it helps us in our automation business, because we automate a lot of these facilities in battery manufacturing, in gigafactories, and that's part of our growth vector. And
so automation or AI? Because AI could also help, for example, in supply chain, I guess, understanding what you need, where you need it, so that you preempt shortage.
We have been using that for probably 3 to 4 years, those techniques. But what excites me about AI is, in context of industrial world, this is one of the best tools to solve the skill issue. Right. Because skill shortage is a huge problem to all our industrial customers, whether it's people to how to operate the equipment, how to maintain it. And AI makes an average person more productive. The example, the thing in point is, I came to UK to live here in 2010. First couple of months, I used to use paper maps and always used to lose my way. Then came the Google Maps, and I never lost my way. So it was early version of AI where I was being assisted by somebody versus I was trying to be intelligent by myself. And I think in that same context, when you translate in industrial world, an operator or a maintenance technician, when assisted by a lot of our AI tools, makes them highly productive. So for our customers, it's a great opportunity to drive productivity and revenue growth, less about job displacement and other conversations.
But I was going to ask you about job displacement, because it must also actually mean that you lose jobs, and so part of that is retraining.
I look at it, there's always a productivity tool which comes in every few years. So this is the new productivity tool. Then skills migrate to higher level. That's how I think about it. And 4 or 5 years back, robotics process automation was a big deal in 2018, 2019. And that wave came in, and it created certain process automation. Now it's AI. So I think the way I think about it is in context of an industrial company is that how do we use it to drive productivity? And then the next wave comes, and we have to reskill ourselves to move on to the next level.
Well, that was Vimal Kapur, the Honeywell chief executive, speaking to me earlier. Now, coming up, Reddit is set to price its shares today ahead of one of the year's most hotly anticipated IPOs. Well, after a long and unpredictable journey to market, we look to see how its fate could be in the hands of its users. That's next, and this is Bloomberg.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working at. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
Bank of America chief executive there, Brian Moynihan, speaking exclusively to Bloomberg Surveillance. Now, the Brookfield chief executive, Bruce Flatt, says he sees opportunity in commercial real estate. The company is one of the world's largest real estate investors and has been exposed to the battered office property sector. Now, in a wide-ranging interview on Leaders with Lacqua, Bruce Flatt told me he believes fundamentals are improving.
Fundamentals are pretty good in a lot of commercial real estate. Of course, there's a tail of some investors that had properties that for this environment, the fundamentals either don't support it or the financing they have can't be supported, and therefore those have to get dealt with. So that's a tail that's getting dealt with within the financial system. Fundamentals are actually getting better. Interest rates are coming down, which means the values are going to improve. But that tail, there's opportunity coming. And if you know what you're doing, you can pick the right assets. There's a great opportunity here, and we've done this for a long period of time, and we've seen these cycles before. Real estate's cyclical, and you can make a lot of money when you pick the inflection point of markets. And I remember it in the early 90s. I remembered it in early 2000s. I remembered it in 2009, 10, 11, 12. There are points when there's an inflection point, and we're at one of those inflection points.
Well, you can see the full interview on Leaders with Lacqua tonight at 9:30 p.m. in New York, and again on Thursday, 6:30 p.m. in London. Now, the social media platform Reddit is set to price its shares today ahead of one of the year's most hotly anticipated IPOs slated for tomorrow. Well, here to discuss all of this is Bloomberg's Charlie Wells. He's been speaking with users of the platform ahead of the share sale. I mean, it's so exciting, Charlie. Welcome to the Pulse. So one widely discussed feature is the fact that the IPO, 8% of shares have been set aside for these Reddit super users. So you've been speaking to them. What are they saying?
Yeah, so I've been down in Wall Street Bets talking to people who go on these forums, talk about stocks, talk about selling, and then now they're talking about Reddit. And it's hotly debated. I think Reddit, everyone's always got kind of a hot take. I've been talking to some of these super users who are invited to take part in this access to these shares. They're offended. They say this is sort of like management coming to a union meeting and offering management jobs to people. Others are really excited, though. They see this as a potential opportunity to make a lot of money off a pop if that share price pops tomorrow.
So, I mean, I guess the Reddit's IPO and the retail interest in it, is it a sign of resurgence in IPOs in general? It's very specific to Reddit.
I mean, look, I think that's what the market hopes. And Reddit has had this kind of long and winding road to an IPO. They confidentially filed in 2021. Well, we know 2021 was a bumper year. The U.S. IPO market hit a record $339 billion. Last year, it wasn't so great. It was $26 billion. So, you know, there was a lot of hope last autumn with ARM. There was hope with Instacart. But look, you know, Reddit, it depends on how they do tomorrow, but there's a lot of companies waiting to see, you know, how they price and how they perform.
So Charlie, how unusual is it actually to offer, you know, some shares to special users?
It's pretty unusual. These are called affinity programs, and it kind of goes back. I love kind of 90s nostalgia. And actually, one of the first real famous examples in the United States was in 1995 when the Boston Beer Company offered people who liked its six-packs coupons in those six-packs that they could then mail back with checks to buy shares. We saw Airbnb do this. They invited hosts to take part. We saw Deliveroo do that here in the UK. It can work really well, but it can also fail if the share price doesn't perform.
Yeah, I think Soho House maybe also tried the same at the margin. Charlie Wells, as always, thank you so much for joining us. Now, a reminder that later today, Bloomberg also has an exclusive interview with Ukraine's Prime Minister, Denis Shmyhal. You can catch that from 12:45 UK time. Surveillance up ahead. This is Bloomberg.